I welcome you all to today's WOW series program, AIF and Gift City by Hrishikesh D, sir. So we are truly honored to have you, sir. I request you to come and occupy the chairs. Yeah, okay. Before we proceed, I request the members to rise up for the motto song. After that, we can do.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
Before we proceed, I'd like to give a short brief summary of Hrishikesh D, CA. CA Hrishikesh D is a chartered accountant with over 5 years of experience in handling statutory audits of large listed entities, income tax assessments, GST assessment, and internal audits. He has conducted forensic audits, due diligence reviews, equity and debt listing assignments, and offers guidance on tax and compliance matters. He has managed income tax assessment and compliance for Alternative Investment Fund, that is AIF, for more than 2 years, including those operating in and through Gift City. His experience include investors and fund level taxation advisory, pass-through taxation mechanism, and aligning AIF structures with evolving regulatory and tax landscape in India's international financial hub. Sir, on behalf of SIRC of ICAI, I welcome you, sir, to this program. To honor his presence with us today, I now request CA Ramesh, sir, to kindly present a memento to CA Hrishikesh as a token of our appreciation. Thank you, sir. So we look forward to have a good engaging session with CA Hrishikesh, sir. Sir, the stage is yours.
Hi, good evening to everybody. Thank you, Mr. Vishnu, for the introduction. First of all, I would like to thank all of you for for having come here, in spite of your busy schedules. I'm sure that all of you must be busy in your audit schedules as well. Thank you for coming. Before delving into the topic directly, let's understand why there is a concept called AIF, why there is Gift City. First, what is an AIF and why was it even introduced? There are already funds like venture capital funds, there are already private equity funds which are already operating. But why at all an AIF? What is the purpose of an AIF? See, earlier what happened was there was a private equity fund or a venture capital fund. They were pulling in money through their sources directly to, let's say, startups. But was there enough regulation earlier? No. So AIF bridges that gap, wherein they bring in that regulation aspect as well, and also they help investors pulling in money from abroad. They give a channel for the sourcing of money to Indian companies. Earlier, there used to be the thing is, for AIF, the main main focus of an AIF is to invest in private equity. Already we have traditional investments such as investments in listed spaces, investments in mutual funds, and so on. But in AIF, it helps the investors who are looking to invest in private companies invest with the AIF. Also, the companies are able to raise funds from those investors. So this is a brief introduction of why an AIF was brought in. Also, there is a growing demand for sectors who are underserved by the banks for raising money. So AIF helps the those sectors also gain sources through these investors. So let's first understand what is the difference between a traditional and an alternative investment. See, the distinction is critical for framing portfolio construction, risk exposure, and return expectations. So traditional investments are basically listed equities, debt securities issued by both listed and unlisted companies, mutual funds offering equity, exchange traded futures and options, or exchange traded funds. These are some examples of a traditional investment method. But in alternative investment, we have an opportunity to invest in private equity as well through direct investments in unlisted stock, and direct investments in unlisted debt securities or loan capital, direct investments in real estate, infrastructure projects and special purpose vehicles, or direct investment in commodities. One main difference between a traditional investment and an alternative investment is a traditional investment is typically liquid in nature. We are able to transfer the investments easily because it's either in a listed form or it's in a listed form. We will be able to transfer it to another person. But in an AIF, we will not be able to directly transfer it immediately. There is generally a lock-in period. So an investor who is looking to invest in an AIF has to keep this in mind. It is not as liquid as a traditional investment. So minimum 3-year lock-in period will be there. Sometimes they might give extensions. So only after the lock-in period is over can an investor get back that investment. However, he'll be earning income through them like interest or in the form of dividend. There is also a dual form of investment which is also illiquid underlying. The assets are illiquid in nature, but instrument itself is transferable, is tradable. So this is the general differentiation between a traditional and alternative investments. Now we will see what is an alternative investment fund. See, let's begin with the background of why SEBI introduced the AIF again. Prior to this, there was growing presence of privately pooled capital, as I was mentioning earlier, operating without clear oversight, without clear understanding of the risks involved, without having investment managers and so on. So to bring transparency, investor protection and market integrity, SEBI has introduced SEBI AIF regulations. So SEBI AIF regulation actually subsumes the earlier introduced venture capital schemes. So venture capital schemes, private equities, all those are to be routed through AIF schemes going forward. The SEBI regulation has been in force since 2012 actually, but only now has it been gaining traction. So I will just go through the definition of an AIF. An AIF typically refers to a fund formed as a trust. Just a minute. An AIF is typically a fund formed as a trust, company or body corporate or an LLP that collects pooled funds from the investors. These funds must follow a defined investment strategy. It's important to note that certain trusts and entities like family trusts, employee welfare trusts, ESOP, gratuity trusts, all those do not fall under the definition of an AIF because these have separate regulations. So all those which already have a regulation, they are not brought into this, except for a venture capital fund. So venture capital fund is subsumed into an AIF scheme now. So generally, if you see the investor profile of an AIF, it is a high net worth individual or let's say a group of investors who are looking to pool in their funds and who look out for investment ventures into, let's say, startups, into edutechs, into medical technology. All these are examples of the target of the investors. It also helps in promoting capital formation in sectors that were underserved. So one of the most important aspects of an AIF is to understand how it is to be formed. It is to be formed in, there are 3 categories of AIF. Category 1, which serves investments in startups, which serves investments in small and medium enterprises or infrastructure, social welfare funds, all these which are typically important for the government, which the government feels is an important sector to promote the economy or the people who are underserved and so on. So this is probably you can term a category 1 AIF as typically important sector for the government. So it has a little leeway given by the government. There are not as many restrictions when compared to a category 2 or 3 fund. So an example of a capital category 1 fund is a venture capital fund or a seed B fund of funds for startups, India Infrastructure Fund by IDFC and so on. I will go on to explain what a category 3 fund is before going to category 2. A category 3 fund is a fund which invests in using complex strategies, hedging instruments, which typically derive at short-term returns, but also the returns are generally higher because the risk involved also is equally high. An example would be a hedge fund like India Opportunities Fund or an IDFC alternative. Now we'll go on to category 2 fund. Category 2 funds are, if in India, the category 2 fund has gained the maximum amount of investment from investors because the risk is medium and the returns are also substantial. So it's a medium risk, long term, substantial growth fund. So the investors typically look at these kind of safe bets even amongst the AIF. Generally, an AIF is considered to be a little more risky when compared to a regular listed fund or mutual fund and so on. Amongst the AIF, a category 2 fund is considered to be a little more safer along with higher returns. So let's say an AIF of category 2 fund, typically it invests in it is looking to invest in a realty sector. There is a real estate company which is looking to gain funds from investors, and realty fund, which is a category 2 fund, can pool in money from the investors and in turn invest in these companies. So Kotak Realty Fund is one example of a category 2 fund which invests in real estate. So this is a broad overview of how much funds are raised by each category of AIF. So in category 1 fund, a venture capital fund seems to have obtained the maximum amount of funds, probably because it's an early stage and high growth business which aligns with India's booming startup ecosystem. I will explain what a venture capital fund is slightly later in the upcoming slides. But what we know from this is a venture capital fund seems to be the highest. It seems to have raised the most amount of commitments as well as funds raised in a category 1 AIF. The second one is infrastructure fund, which invests in roadways, highways, or even let's say a logistics business. All those come under infrastructure fund. Amongst all the 3 funds, category 2 funds, as I said earlier, has received the maximum amount of commitments, funds raised as well as the investments made. Almost it's coming up to 60 to 65% of the total amount of funds raised. Okay. This shows the profile of the investors in each category of investment, each category of AIF. Category 1 fund, as expected, almost 70% of the investments are from foreign investors or from domestic investors. Category 3 fund, surprisingly, 90% of the investors are from domestic market. One reason could be because category 3 funds are still in nascent stages of regulation, where there is certain gray areas in category 3 fund, so it's slightly more riskier. But a category 2 fund seems to have almost 50% of domestic and foreign investors. One reason for category 2 funds receiving equal amount of foreign investors as well as domestic investors would be that it is more stabilized, and category 3 funds are more complex, as I explained earlier. Yeah. So this next we will see how a category 1 fund can be formed. Category 1 fund can be started, or it has to be registered as one of the subcategories. This is not the case for the other 2 categories of funds, but a category 1 fund alone has to register as one of these subcategories, namely venture capital funds, infrastructure funds, SME, special situation funds, and social impact funds. Venture capital funds, as the name itself says, these funds invest into venture capital. I will again explain what a venture capital is. Infrastructure funds are for government sectors such as roads, energy, utilities, and so on. SME funds target these small and medium enterprises. So these funds invest in small and medium enterprises basically who are looking to raise loans. Now we come to special situation funds. So typically, an example of a special situation fund would be in a real life situation, a Kotak special situation funds is there. I'll give you an example of how a special situation fund works. Let's say a company, an automobile company is into, is going through a rough patch and they have loans outstanding of about 1,000 crores. Special situation fund comes into play now. The company is looking to settle the loans, but they also do not want to give off the company as a whole through an IRP procedure or liquidation procedure. So what happens is a special situation funds, they look out for such investments, they look out for such companies who are distressed, who have distressed loans and assets, and they, after doing all their due diligence, they from the pooled in money from the investors, they in turn invest into these stressed companies. So let's say the loan outstanding is 1,000 crores. The special situation fund, it comes in, it discusses with the bankers, and they settle the loan amount for about 700 crores with a 300 crores haircut. They will invest the 700 crores and probably with some additional capital of let's say 100 crores, they will run the company for about 2 to 3 years. Once the turnaround is done, they will try to liquidate their assets by either listing it in an IPO or transferring it to another party. After the turnaround is done. So what happens is an investor in a special situation fund, he will be earning income probably through interest or dividends which the special situation fund gives, but the special situation fund will be able to take out the investment made only after the turnaround is done. Maybe it may take a couple of years, given that it has to run the company as such. So that's how a special situation funds work. It might be similar to an asset reconstruction company. So now let's see what a social impact fund is. See, a social impact fund, it focuses on business delivering measure, where the measurement is based not on profits but on social value addition. I will give you a real life example. I think you might have heard about Samunati Finance. So Samunati Finance, it finances agri-tech companies, those companies which are into agricultural technology and probably like let's say seed technology and so on. They want funds. Samunati Finance will provide loan to the company. So how will Samunati Finance raise the funds? It will raise funds through these social impact funds. An example is there is an example in Avishkar Capital and Elivar Equity. So Elivar Equity invests into Samunati Finance. Samunati Finance in turn gives money to the company which requires funding. So the investors of social impact funds, typically the investors might not be looking out for profits of a social impact fund. They might be looking at real value additions for the society as a whole. These funds are generally handled by those who are looking at philanthropical, doing philanthropy and so on. So that's how a social impact fund works. So these are the subcategories of a category 1 fund. So next is we'll just run through certain primary conditions for setting up an AIF. The first one is the AIF can be set up only through private placement. No public funding is allowed. However, units of, I have not explained what a closed-ended fund is or an open-ended fund is. So in general, an open-ended fund is one which does not have a maturity period, but a closed-ended fund has a fixed period of let's say 3 years. Typically, a category 1 and 2 funds are close-ended. They cannot be open-ended funds. Only category 3 funds can be either open-ended or close-ended funds. So private placement only can be done for if you want to set up an AIF. However, there is an exception. If the close-ended fund wants to raise money, it can do so by public listing. Only a close-ended fund can do that. Then the minimum corpus requirement is 20 crores, 5 crore for social impact fund. There's a little leeway for a social impact fund. Minimum investment per investor is 1 crore per investor. So an investor in an AIF has to have a minimum investment of 1 crore rupees. And for employees or directors of companies or for the AIF, 25 lakhs is an minimum investment. For social impact funds, they have again given certain leeways by reducing the minimum contribution to 2 lakhs per investor. Given that the social impact fund can invest only in social stock exchanges, which are not for profit typically. And the next one is there should be a continuing interest by the manager or promoter or the sponsor. I will explain what a manager or sponsor is. A sponsor or a manager a sponsor acts as a promoter of let's say a promoter of a company can be equated to a sponsor of a fund. A sponsor is one who sets up the fund, who helps manage the fund apart from the fund manager. So his investment has to be there continuously. So that is what a continuing interest is. So he needs to have a corpus of 2.5%. He needs to maintain a corpus of 2.5% or 5 crore, whichever is lower. For a Cat 3 fund, this is raised to 5% of the corpus. Given the nature of the fund of a Cat 3 fund, it can be an open-ended fund also. So there are slightly more restrictions there. I will explain what a co-investment is. Supposing there is a manager, there is a sponsor of the fund and also the fund itself. They are investing in a startup. For the fund invests in the startup for let's say 100 rupees or 1000 rupees. The co-investment means the sponsor as well as the manager are also investing in the startup, but this cannot be lower than the amount invested by the fund. And the maximum investor limit in a particular fund scheme is 1000. Few investment conditions are also there for an AIF. As I said earlier, AIFs are more regulated and hence there are certain restrictions on the investments that can be made. However, foreign investments are allowed provided they satisfy all the RBI conditions and SEBI registered conditions. Co-investment, as I explained earlier, it has to be maintained. Cat 1 and Cat 2 funds, they can invest maximum 25% in one company, in one investee. So assuming Cat 2 fund is investing in a company and it has a corpus of, it has a fund balance of 100 crores, it can invest maximum 25 crores in one company, not more than that. This is brought in to restrict the concentration of funds in one company alone, in one investee company alone. For a Cat 3 fund, it is slightly more stringent. Only 10% of the total funds can be invested in an investee company. No mutual cross AIF subscriptions allowed. Fund of funds are not allowed. 75% investor approval is required for associate transaction. An associate transaction can be related to can be equated to a related party transactions as we see in Companies Act. An associate can be a sponsor, a manager, or someone who's holding more than a certain limit of funds in a AIF. So if a fund is entering into transactions with that associate, they will have to have 75% approval of the investors. And all the units have to be issued in a demat format. Yes, for all funds. Demat format. Till now, if you have any questions, you can feel free to ask, so that it might not be boring for all of you. If there are any questions or any doubts till now, we are looking at AIF now. We will move on to Gift City in some time. Okay, I'll move on to the next one. There are certain conditions for each type of Cat 1 AIF. For example, a venture capital fund. Most of this is relating to how much minimum investment can be made by all the types of funds. Okay, so when a venture capital fund invests, at least 75% of the investable funds should be in unlisted equity or SME listed companies, so that it maintains the status of a venture capital fund. They can't be investing in a different category of an investee. They have to invest only in a venture capital fund. An SME fund can invest 75% in SMEs or SME focused category 2 AIFs. A social impact fund, at least 75% should be in social venture funds. Infrastructure fund can have about the same amount, 75% in infrastructure related companies. However, each fund, there are certain special provisions, like the venture capital fund may participate in market making and get limited insider trading exemptions. SME funds can enjoy market making rights and insider trading exemptions. Then social impact funds can accept grants over 10 lakhs without profit sharing rights, obviously. And not-for-profit SIFs can invest 100% in social stock exchanges. An infrastructure fund is allowed to invest in listed debt instruments of infrastructure companies. For Cat 2 and Cat 3 funds, what are the conditions? The all the category 2 AIFs must invest in unlisted forms of investees. They also can invest via Cat 1 or Cat 2 AIF, another Cat 1 or Cat 2 AIF as per the placement memorandum. Typically, what happens is, before an AIF raises money, how does an AIF raise money? I don't think I've addressed that. They have to issue a memorandum. Just like how we have prospectus for listings, an AIF has to issue a private placement memorandum, which will be uploaded in the SEBI website also. The investors have to look at this, and then whoever is interested, they have to fill in the placement memorandum, and all the what is the amount that they are going to invest, which category of funds they are going to invest, all that will be in the placement memorandum. So that is how an investor can invest in an AIF. So again, coming back to category 2 AIFs, they cannot borrow except for short-term loans for maximum period of 30 days. They can borrow, and 4 times in a year, and maximum up to 10% of their investable funds. However, they can create an encumbrance on infrastructure equity for investee borrowings. So what the regulation is trying to say is, let's say a category 2 fund has invested in an infrastructure company, and they want to raise funds, they want to raise a loan. The holding that the category 2 fund has in the infrastructure company, that can be given as a pledge to the lender. So an AIF can act as a guarantor. The category 2 AIF can act as a guarantor. They cannot borrow directly. So hedging and credit default swaps are allowed as per the SEBI regulated norms, and they also enjoy some SME related market making options, and they have insider trading exceptions as well. Category 3 AIF do not have such specific conditions for raising money, but one condition is they need to have they can raise maximum up to 3 times of their NAV. A category 3 fund can raise up to 3 times of their NAV. So this now let's talk about angel funds and how they operate under SEBI. Earlier, there used to be separate regulation for angel funds, venture capital funds, and so on. Now, all these are brought into an AIF regulation, SEBI AIF regulations. So, generally, an angel fund form comes under the category 1 AIF. They target early stage startups with high net worth individuals and institutional backing. It is similar to how angel funds were working earlier. This, the venture capital funds, however, I'm explaining how a venture capital fund is different from an angel investor fund. The venture capital fund typically invests in later stages of a startup. However, an angel fund can invest in early stages. Venture capital fund may be at the time of the pre-IPO or something, when the company needs, when the startup needs funds, the venture capitals come into place. An angel fund is even more earlier, even before the operations start, even before the bankers come into picture. Even before the working capital kickstarts. Basically, the angel investor is one who invests into the idea of the company. He is basically investing because he finds the idea attractive. So there are certain conditions for an angel funds under SEBI AIF regulations. Category 1 AIF subtype, raising capital from qualified angel investors. The investors have to be having a net worth of 2 crore minimum, and it has to be tangible net assets apart from the place of residence that he stays. And the corporates, if a corporate company is looking to invest into the angel funds, it needs to have a net worth of 10 crore minimum. Minimum corpus of 5 crore private placement of units, maximum 200 investors per scheme. And next one is There are certain investment parameters. There should be minimum 25 lakh commitment per investor held for up to 5 years. Investors can invest 25 lakhs to 10 crores per startup. 10 crores is the maximum amount. A lock-in period of 1 year per investment is there. Investors can invest only in startups in the case of angel funds. These startups are not part of industrial groups and who have a turnover of 300 crore more, and they are not linked to any investor group. The sponsor must hold the lesser of 550 lakhs or 2.5% of corpus approval in mandatory, and is mandatory for investments in angel funds. And no investments are allowed in associate entities or excessive allocation to one venture. Then we have certain fund level regulations that each fund has to follow, like a custodian appointment. All AIF has, with a corpus of 500 crores more, must appoint a SEBI registered custodian. All category 3 AIFs must appoint a custodian irrespective of the corpus raised. If there is a change in control, prior SEBI approval is mandatory. Books of accounts have to be audited by a chartered accountant. Disclosure of key information has to be done to the investors. The important point in this is each AIF has to have annual disclosures given to the investors. Category 1 and 2 AIF can have half-yearly disclosures to the investors, whereas a category 3 AIF needs to have monthly disclosures. So that, actually they should be having, they must report within 60 days of end of each quarter. So basically they have quarterly disclosures, a category 3 AIF, while a category 1 and 2 can have half-yearly disclosures. And each fund must undertake valuation of their net assets. What is the value of each AIF has to be done. For CAT 1 and CAT 2, mandatory evaluation for every 6 months is there, but a CAT 3, it has to be done for every quarter. And valuation also opens up opportunities for chartered accountants. These are certain roles in AIF: a sponsor, an investment manager, a custodian, and a trustee. A sponsor is one who establishes the fund and initiates a SEBI registration. He acts in a fiduciary capacity for investors. Investment manager is the one who manages the investments made by the AIF. He devises the strategies, where to invest and how to invest, and he also gets an investment management fee from the AIF. A custodian is one who safeguards the funds of the assets. A trustee, in the case it is set up in the form of a trust, it monitors the compliance and operations of the investment manager. So till now we have discussed about AIF. If you have any questions, next we'll move to Gift City. If you have any questions till now, we can discuss. Yes, mostly AIFs in India are registered as a trust, but they also have an option of registering as an LLP. Typically in India, maximum amount of AIFs are starting up as a trust, and they will have a trustee and an investment manager as well. LLPs are allowed. LLPs are also allowed. What could be the taxation aspects? I will cover it in the upcoming slides. I will explain about Gift City and then the taxation aspects of AIF and Gift City. So we'll then move on to Gift City then. What is Gift City and what is this IFSC that we've been hearing about for some time now? Actually, this IFSC was brought in almost let's say 6 to 7 years back, but only now it has gained traction. Gift City is India's only IFSC, and it typically means Gujarat International Financial Tech City. It was started to have an alternative to offshore funds, which were generally situated in Singapore, Mauritius, or Cayman Islands, for example. The initiative of the government the intention of the government was to bring in the offshore funds to onshore, and they wanted to create a space in India itself. Although the space was in India, it operates like an offshore fund itself. It operates like an offshore company. It is an SEZ, yes. Gift City is situated in an SEZ. All the SEZ rules also apply. So it caters to markets such as financial services, banking, insurance, capital markets, and so on. It is mainly for financial aspects of the company. So you can't set up a manufacturing company there. You can't set up some textile company and so on. It is for financial aspects. But you can have back-end offices in IFSC for all those manufacturing companies also. And it is regulated by the International Financial Services Centers Act, IFSC Act, which subsumes SEBI, RBI, and so on. And this becomes simpler for overseas investors. See, main idea behind IFSC is to bring in investors from abroad, and also for Indian investors to get a feel of the capital markets outside India, how it is. Because an IFSC is allowed to invest in capital markets outside India as well. So it serves the dual purpose of getting in foreign investors. It also helps the Indian investors to gain to also invest in outside India markets. There are two stock exchanges operating in Gift City: Indian International Exchange Limited (INX) and NSE IFSC Limited. So these all deal in foreign currency. All the markets for the exchange markets in the IFSC deal typically in foreign currency only. The fund management entity will be regulated here and not the fund itself. That is one differentiation between regular AIF and an AIF and IFSC. And it provides an opportunity for offshore investors. There are a couple of ways in which an investment can be brought into an IFSC. Yeah. So the first one is inbound investment, where an offshore investor, a foreign investor, invests into IFSC. He brings in money from abroad. He invests in an IFSC, and IFSC in Gift City in Gujarat, it in turn invests in the companies in India, or it can also invest in companies outside India. That is how an inbound investment is. An outbound investment is basically an Indian investor who is looking to invest in, let's say, foreign capital and so on. He invests in IFSC, and the IFSC in turn invests in companies outside India. That is what an outbound investment is. Sorry? Yes. The bank accounts will be maintained in the IFSC itself in foreign currency. So there is no INR here operating here. It's all in foreign currency. Banks are also operating in whatever banks are there in IFSC. They will be doing all the management for them. So you'll have to set up a bank account in IFSC. That's how it operates. Yes. Correct. You will have to open an account in that offshore in IFSC. Only then you will be able to transfer. You will be, supposing you have a branch in India, which and you're looking to open a company in IFSC Gujarat. You'll have to open a bank account there. That's how it operates. And for investors also, they'll have to have so for the foreign investors, they might invest through some vehicles here, like an AIF, for example. So they can directly invest in an AIF through their foreign currency account itself. They don't need to have a bank account here. Similarly, an Indian investor they don't need to have a bank account in IFSC. But if you are setting up in IFSC, you will need to have a bank account. So Indian investor can directly invest in the IFSC stock exchange. And the foreign investor also can invest directly in a stock exchange in IFSC. You don't need to have a bank account there. So dematerialization, yeah, that doesn't apply directly here. Correct. Yes.
How does the Indian investor invest in the IFSC?
So they can invest through their bank accounts, while that will be like a foreign currency transaction for them.
So that will be under LR.
It will be, yes, so I will come to that. And for an Indian investor, it will be like they'll have to follow an LRS scheme, the $250 limit. It will be applicable for the Indian investor because it is like a foreign transaction for them, foreign investment. So they will have to follow all those guidelines. But up to 250, they can directly invest. I will explain about the investment types. Actually, even if the Indian company wants some Indian entity, if they want to list their capital in IFSC, they can also do that. So this is a broad comparison of jurisdictions. What all jurisdictions apply for a GIFT City, and what are the type of investors falling under that category. For FEMA purposes, GIFT City is non-resident. So an Indian investor, supposing they are raising capital from, they are having a borrowing from GIFT City, it will be treated like an external commercial borrowing only, because it is a borrowing from outside India for FEMA purposes. For currency there are about 15 currencies operating in IFSC, but INR is not allowed. And taxation angle, it is considered as a domestic tariff domestic area only for income tax purposes, although there are certain carve-outs which we will be discussing later. But for income tax purposes, it is still coming under, it will falls under the purview of Income Tax Act only. And apart from that, the regulator, as I said, is IFSCA. It subsumes RBI, SEBI, IRDA, and so on. Yeah. See, it isn't for. Yes. Correct. No, the definition of resident means from FEMA point of view, you're asking? No, that has not been changed. This is considered as a foreign territory for FEMA also. Yes. Correct. Correct. It is an overseas portfolio only for Indian investor, because the regulation itself, it talks about investments in IFSC as a foreign currency transaction only. So it is an investment outside India, and FEMA also mentions that any investment into IFSC will be a foreign transaction. Yeah. If it is not falling under LRS,
the idea we're mentioning that this is for the investment for overseas company and all. That
Correct.
is routing through that.
Correct.
So if that be the case, if I don't do this GIFT City, I have to do the overall transfer through ODI route only.
regular ODI route only.
So now the only advantage is that I can do in foreign currency here.
Correct, exactly. So that, yeah.
Yeah. So what is the procedure then?
No, so if you are an independent investor, you are looking to invest in GIFT City, the same procedure that you follow for transferring money outside India applies now also.
Okay.
That LRS scheme applies here also.
Okay. But not on the LRS perspective, but an investment perspective.
Okay.
So like normally what we do is we approach our our bankers, and they will get an approval from
Correct.
RBI within the certain limit. Through our RBI approval, with our
Correct.
RBI approval we can only invest.
Correct.
So if I go through GIFT City, then this approval can
Same. Even if it's through GIFT City, this approval is up to the 250,000. More than that, you will need to have those approvals as well.
Okay.
Yes.
Okay.
Up to 250,000 only that approval will be there. There is no automatic approval as such.
So all the
So that will apply. That will apply.
So what is the then difference?
See, difference is there are certain there are two differences. One is for an Indian investor, he gains access to a capital investment in India itself, an offshore capital investment in India itself. There is no differentiation between what was there earlier for an Indian investor. Mainly, it is brought in for foreign investors who are looking to bring in money here.
Okay, for inflows only.
Mostly.
Okay, understood.
Mostly for inflows from abroad. Because all these SEBI regulations earlier, which FEMA regulations were there earlier, it still applies for an Indian investor investing in GIFT City. There is no relaxation as such. There are certain registration requirements for AIFs and IFSC. Some threshold limits are there. First of all, an AIF has to be, there is a concept called fund management entity in an IFSC. Fund management entity is principally the one who is regulated by the IFSC rules. Although the funds are the ones who are having the funds, a fund has to be registered under a fund management entity license. So the funds, if they're looking to start up, they'll have to get a fund management entity license from IFSCA. And the fund management entity will be the one who's regulated. So fund management entity generally falls under three categories. An authorized FME or a registered FME non-retail or a retail registered FME. If you are looking to start an AIF, it has to come under a fund management entity. Only then they will be able to get a registered license through the IFSC. So an AIF will fall under a fund management entity, and only through that scheme will we be able to raise funds. You can't have a separate AIF registration in IFSC. So an authorized FME needs to have minimum net worth of 75,000. Registered FME, a non-retail, needs to have about 5 lakhs minimum net worth, and a retail FME has to have USD 1 million. Family investment funds are typically not highly regulated because they are all investing in family funds, so there is no minimum net worth requirement. I've just pasted a screenshot from the IFSC annual report, which gives us an idea of how much each scheme is, what are the value of funds raised by each scheme. A venture capital fund has raised the venture capital funds have raised 19.71 USD million, out of which the angel schemes form 4 million. It is as of 31st March 2024. The restricted schemes, of which category 1 and 2 AIFs fall under, they have raised 2,467 USD million. Category 3 AIFs under the restricted schemes have raised about 1,208 million. And yeah. You are talking about LLP or
No.
yes,
Not
correct.
on that, but see, for example, this retail scheme, there is either, I'm not sure whether it's retail or non-retail. The subcategorization of whether it is an AF category 1 or category 2 is not there, right, for one of the
Correct. It's for the retail scheme, there is no categorization as such. But since we are talking about AIFs and how the AIFs can be relevant in IFSC, if let's say there is an AIF set up in IFSC under this FME regulation and they invest in startups, they fall under the category 1 and 2 AIFs. The categorization is still there, but it might not be, you don't have to register under one particular category. This is only for giving an idea of how much each type of AIF. The investment nature still is the same.
Okay.
The category nature will be the same, but you don't have to register as category 1 or 2 AIFs.
Okay.
You will have to register as a retail fund or a non-retail fund or an authorized FME fund.
Okay.
Basically, an FME can be there for any category 1, 2 or 3 fund, right?
FME can be there for any fund.
fund. So if you want to set up an FME, this is the basic requirement.
Correct.
So it doesn't matter what
Yes.
you regulate or how you form or how you do that, right?
Yes, FME can be, FME is a regulator which can be categorized into category 1 or 2 funds for our categorization purpose. However, now even mutual funds, FMEs are also having mutual funds as part of their schemes. So we are only talking about schemes now. So category 1 is a particular scheme, category 2 is a scheme which category 2 invests in startups. That is a scheme which comes under FME regulation. So you don't have to typically register as a category 2 scheme separately. And one more thing is the AIFs can be the AIFs can be structured as a company or a trust or a branch. If an Indian company wants to have a branch in IFSC and have an AIF there, they can set it up as a branch also. Need not be only a LLP form. The branch structure is, however, permitted only for an FME which is already registered or regulated by a financial sector regulator in India or a foreign jurisdiction also. So they should either already be falling under a regulator outside India or inside India. In that case, they can set up a branch abroad. For example, companies fall under Companies Act, SEBI regulations also. They can set up a branch in IFSC. However, if they are individuals or they will not be able to set up a branch there. These are certain registration requirements for AIFs and IFSC. An authorized AFME generally has accredited and institutional investors, having more than 2.5 lakh US dollars net worth. Then the permitted activities for an authorized FME is early stage ventures, startups, venture capital funds, and so on can be related to a category 1 fund. Net worth requirement is USD 75,000, and legal form is, as I explained earlier, company, LLP, or a branch. There are certain basic disclosures which each FME has to do. These are pretty basic for an authorized FME. Compliance requirement is simplified when compared to the other FMEs. In the case of a non-retail FME, you have the target investors are generally accredited investors who are professionals, who have net worth of more than USD 1.5 lakhs and so on. High net worth individuals fall under this category. Those are the target investors here. And permitted activities are they invest in restricted schemes, portfolio, and fund management services. Net worth requirement is 5 lakhs USD. Legal form allowed is company or branch only. Investor protection norms are they have disclosure norms, and also it's moderately regulated with respect to the compliance. Retail FME is slightly more moderated because they deal with the investors directly. So the general public access. You have mutual funds. These are the target investor permitted activities. Sorry, you have mutual funds, ETFs, and retail-oriented funds. In yesterday's newspaper, I think if you have read, mutual funds are earlier IFSC used to be dominated only by AIFs. Now mutual funds are also setting up their bases in IFSC. It's just picking up. Right now, AIFs are the funds which are dominating there. Net worth requirement is USD 1 million. It can, any legal form is allowed. Investor protection is strict because they are all retail and general public is involved. And the Indian AIF industry grew 30% in financial year 23-24 with asset under management rising to 8.34 lakh crores from 6.41 lakh crores. Category 2 AIFs led the growth, reaching 6.94 lakh crores, a 34% increase year on year. And one more thing which I didn't mention was a retail scheme cannot be in the form of an AIF. It has to be in the form of a company or an LLP or a branch. It cannot have an AIF. Yeah. Now we'll see certain key income tax provisions which are applicable for AIFs and GIFT City as well. The main sections are highlighted here, like 115 UB, 1023 FBA, and so on. So till now, do you have any other questions? Can we move on to the tax angles? Yeah.
Say a resident here, will that be treated as an import of service for the purpose of FEMA?
Correct, it will be. For FEMA purpose, it will be. Aircraft leasing companies are actually setting up their bases in IFSC now in a large way. It will be treated as outsourcing of services only.
So I will be governed by that master direction on import of goods and services.
Correct. Okay. So basically, these are aircraft leasing means they raise funds for the aircraft financing from IFSC. They don't. Mostly these funds these companies situated in IFSC, they involve themselves in raising funds, issuing loans, and so on. They don't actually do real-time leasing. They act like companies which assist in leasing, but mainly they are involved in financing of those companies. Because an IFSC concept itself is for financing and for financial sector regulation. So they can lend funds to aircraft leasing company. That's how they are set up. Yeah. So one very, very important aspect in taxation angle is for a category 1 and 2 funds. Now we are looking at AIFs as such. For a category 1 and 2 fund, it is they have a pass-through status. The funds have a pass-through status. That means the income earned by the fund is not taxable in the hands of the fund. However, if it is a business income of the fund, it will be taxable in the hands of the fund. So there is an investor, there is an AIF in which he has invested. The AIF in turn invests into investee companies, and the investee company issues dividend, issues interest, and so on. All these dividends and interest, they are not taxable in the hands of the trust as such. They are taxable only in the hands of the investor. The trusts have a pass-through status. So this is what is meant by a pass-through. However, if the trust is also, if the fund is also doing a business, they are having a business income, this will not be passed on to the investors. I will explain the difference between business income and other income in the next slide, because that is also important. Apart from that, I will just move on to the actual slide. Yeah. So the first criteria is, the first exemption given is, in the case of funds set up in IFSC, they have a tax holiday of 10 years out of the first 15 years. This is similar to how startups had tax holidays as well. So AIF can choose what is the 10-year period that they want to. However, it has to be a consecutive period. Generally, once the company starts earning good returns, only then they will choose this tax holiday. So probably later stages within the 15 years, they might choose to avail this tax holiday. In this case, all the business income is completely exempted from taxation under section 80 LA. Sorry, I think this is the slide. So under section 80 LA, the tax holidays is there for AIFs and IFSC. There's a 100% tax holiday on business income for 10 consecutive assessment years out of 15-year-old block. It is applicable to AIFs registered as a unit in IFSC. 15-year period begins from the year of registration. From the year of registration it begins, and business income is taxed at the AIF level. Yeah. What is a business income? Yes. So I will go to that slide now before explaining the other things. So what is business income? How is it different from other income? How to classify it? Typically, the role of an AIF itself is only to be a conduit. It is not to earn any business income through any other activities. So there are certain key indicators for characterization. For example, at the time of investment, if the intention is only for capital appreciation, it is a capital gain, it is not a business income. See, all these are all a little litigative as well. There have been case laws going on to, in which the officers have ruled that this is business income, this is capital gains. It has to be addressed on a case-to-case basis. So typically, the intention at the time of acquisition is a capital appreciation, then it's capital gains. And there should be low transaction frequency, let's say once in a month or once in a quarter. Long holding periods are intended. Then they are shown as investment in books and not as stock in trade. Because that's one proof that it is actually investment, not used for trading activities. And the funds is maybe one more indicator is the fund is the amount is funded through own capital and not through borrowed funds. Then the constitution of the company is long term. The constitution object is long term. Substantial control over portfolio companies are also there. So since the funds have the pass-through status, all these categorization come into picture, whether it is business income or a capital gain. Because 115 UB itself clearly specifies that business income is taxed in the hands of the funds, non-business income only is passed through. So sometimes it becomes a little difficult to prove to the assessing officers what is business income, because we faced few cases where the assessing officer said all these have to be taxed in the hands of the fund only. So it took us some time to explain that these are all only investments made on behalf of investors. They are not having any business income. This is actually given as per the section also, and we had to tell them that this is for capital appreciation. This is not for like short-term trading purpose. This is on behalf of the investors. We have to show the assessing officers what an AIF is, how the constitution of an AIF, and so on, to prove that it is actually not a business income. So that's how it operates here.
What if the entry exit period is very small, say within a year?
Even if the entry exit period is within a year, It generally, if you are classifying that as an investment in your books, then we can categorize that as a capital gain rather than a business income. Even if it's short term, if it is if the intention at the time of investment, or in the books if you classify that as investments and not trading or stock and trade or something. Correct. No, so certain companies, they are actually into trading of stock, so they might not show that as investments. That's how we have to explain. So yeah. So I've explained what a pass-through status is. The next one is yeah. The next important aspect in taxation is how to treat the losses that are accumulated in the fund level. If it is losses from investments, they will be transferred to the investors directly. The fund cannot claim any of the losses, obviously. So in case of business income, the unabsorbed business losses can be carried forward and set off by the AIF. A business loss typically is carried forward for 8 assessment years. That will be the same in this case. If it is speculative income, it is only for 4 years. So that will be the case for the AIF, because if it's a business income, it has to be taxed in the AIF itself. But for other losses, it can be carried forward and set off by the investors, provided there is only one important condition: the investors have to have investment holding of 1 year minimum. Only then will they be able to set off this loss. So that is how losses are treated in case of AIF. So it might become a little tricky when we are filing the income tax returns of these AIFs, because we'll have to show these as in case of a category 1 and 2 fund, these are all exempt in the hands of the funds. This has to be passed through and all that. So this will be shown as exempt income in the hands of the funds in the returns, and the investor has to show that as income from AIF. So it will be a loss in this case. That's how they carry forward the losses. And in the loss schedule also, they will be showing as loss from the AIF. How the investor will get the data from, so that's what I'm going to explain again in the upcoming slide. So the thing is, the AIF, they have to submit yearly reports to the investors. These are all income tax forms which has to be filed. I will just go through that first then. Yeah, there is a form called Form 64D. So this is the form that tells the investor what is the nature of income, whether it is a capital gain, whether it is interest, whether it is dividend. This has to be filed by the companies every year. Typically it's on 15th June of every year. This will be filed by the category 1 and 2 funds, because only those are pass-through funds. This shows the statement of income earned by the investor. It will show the investor location, the country of residence of the investor, if they are a non-resident, whichever country they are residing in. What is the income that is given by the AIF to the investor, nature of income, all that will be filed in this form. And here for chartered accountants, the role is they have to certify this nature of investment that the company issues. So the chartered accountant has to give a certificate that I have verified the nature of investments, I have verified the income categorization, and all these are found to be true. This has to be submitted to the income tax department while filing Form 64D. And 64C acts like Form 16, where if we file a TDS return, we have to issue Form 16 to the deductees. So Form 64C is a certificate given by the company to the investors that will show the details which are there in 64D. So that is how an investor will know what is the nature of income received from the fund. And this, in case he is going to claim a refund, this will be disclosed in his income tax return. Generally his income tax return filing stops. He doesn't act, now overseas investor need not typically file an income tax return if the TDS is directed correctly. I will now go to the withholding tax angle. So at the fund level, there is no TDS deduction, because for a category 1 and 2, we are only talking about category 1 and 2 funds now. We have not come to category 3 taxation. So category 1 and 2 are only pass-through. Category 3 is not a pass-through fund. It is tax in the hands of the funds only. So now we are looking at withholding of taxation in the hands of the funds. First, the fund at the fund level, what is the withholding tax? The investee company, the company in which the fund has invested, typically will not be withholding any tax in the hands of the fund because it is not taxable in the fund's hand. For that, the fund will give a certificate to the investee company that I am having a pass-through status, do not deduct tax. So that is the case. That is mentioned in 197A section. Then it applies, of course, only to non-business income. In case of a business income, they will have to deduct tax. And this ensures pass-through status is effective at source level. There is no double deduction of taxes. And now, what are the tax implications? What are the TDS withholding regulations for at the fund level when it passes through income to the investor? That comes under 194L BB of the Income Tax Act. So the AIF must deduct TDS while distributing income to the unit holders. Generally, it is 10% TDS. 194 LBB for resident investors, it is 10%. 194 LBB is a section which talks about the withholding tax. Under that, they are classifying it into two. One for resident and another for other than residents. For residents, it is a flat rate at 10%. The TDS has to be withheld at 10%, irrespective of the nature of income. It may be interest, dividend, or capital gains. And applicable rate for a non-resident is, it depends on the tax treaty. You have the double taxation benefits as well. For a non-resident, we will have to consider what are the taxation benefits given under the tax treaty and then deduct tax. So another very, very important aspect here is, even if the fund has not distributed the income to the investor at the end of the year, it still has to deduct tax on an accrual basis. So the income earned by an investment fund is deemed to be credited to the investor's account on the last day of that year if it has not been distributed till now, till the end of the year. So these are the rates. For a resident is 10% flat rate. For a non-resident unit holder, here the interest income is taxed under at 30% under the IT Act. However, for in most of the cases, they have the DTA benefits, provided they give the TRC, provided they give the Form 10F. I think many of you might be aware of the tax residency certificate, which the foreign investor has to give, that he does not have a permanent establishment in India. So that has to be given to the fund. Yes. Yeah. Sure. So the deemed income is, the thing is, there might be cases where, let's say there are 4 quarters in a year, and the fund has distributed income only up to Q3, third quarter. For the 4th quarter, the fund has not yet distributed income. Probably there might be some restrictions it is facing with respect to some bank issues or something like that, or it is simply not distributed the income. They have received, but they have not yet distributed. So in that case, where the fund has received the income and not distributed to the investor, it is deemed to accrue to the investor. Even if it is reinvested, yes. So even if it is reinvested, it is like an income to the investor. It is deemed to be an income to the investor. So just like how we are reinvesting this interest income in FDs and all that, even though we are reinvesting, we are still showing that as an income every year, right? We are accruing the interest every year. Similar to that. This is in 194 LBB. Yeah, that itself clearly says it has to be done. Proportionately, we'll have to calculate and do. So I was discussing about withholding tax in the hands of the non-resident. For a non-resident, you'll have to look at the tax treaties as well. Here again, this is an area of specialization for chartered accountants where we come into picture. We'll have to take the fund has to receive the TRCs, see what the rates are as per the Act, the Income Tax Act, as well as the DTA, see what is beneficial, and based on that, they have to deduct tax. So interest income is typically taxed at 30%. However, DTA benefits are about 10 to 15%. Dividend income is 20%, and it varies for country to country basis in DTA. DTA is a double taxation avoidance agreement. Long-term capital gains. So here there is a slight complication where it is taxed under for an as per the Income Tax Act, it is taxed under Section 112 at 12.5%. Surcharge is based on the income tax slab of the investor. However, it is capped at 15% because it is a long-term capital gain, and the effective TDS rate generally comes to 14.95%. So here what happens is we will be from the income tax angle we will be calculating tax at 14%, but in most cases when we look at the DTA benefits tax treaties, most of the tax treaties they tax the investor only at the country of residence, except for countries like UK or US. Most other European countries, countries like Dubai, other UAE places, all those have taxation only in the hands of only at the country of residence. So short-term capital gains again, it's taxed as per the rates in force, and surcharge is capped at 25% in this case. So I've just included a slide for comparison purpose how a DTA benefit plays out for capital gains income. For a non-resident, as I said earlier, US, UK, Hong Kong, all those are taxed as per Indian domestic law only. But if the investor is from other than these countries, generally the majority of the countries are taxed in the residence. Then no TDS if DTA applies in that case. Form 10F and Form 10F and TRC is important. So TRC is a declaration given by the revenue authorities in those countries that they don't have a permanent establishment in India. They have a permanent establishment outside India and in whichever country, and this is their address and everything. That has to be there. And Form 10F is maybe needed where they do not have the details required in a TRC. Another important exemption for a non-resident investor is under 114 AAB rule, where they don't have to take PAN. So they are exempted from taking PANs if they provide certain disclosures to the AIF. Now we will move on to category 3 funds. So till now any other questions for category 1 and 2 taxation? Company fund.
In the Form 64, and the due date for filing the return, you are saying that it has to be filed before
Correct.
June. And the tax audit will be done by, if suppose if it is done by some other person report.
Tax audit report.
So if he doesn't carry the accrual in the books of accounts, if he doesn't report, the investor will know what he has given, so he will go only by that.
They will not, the investors will not be aware of what is the accrual, because the funds, if the company does not, it is basically self-declaration. Yes. Otherwise the investor will not be aware. But the thing is, they will have to accrue their investment, accrue their income, because they also fall under accounting standards. So there are accounting standards that are applicable for fund also, which I will explain later. But since they have accounting standards, they will have to accrue. Yes, correct. And they also have to file their quarterly reports under SEBI also. What is the income earned from each investments? That also has to be done. So in most cases it will be difficult to not disclose, because it is regulated under SEBI also. They will have to give disclosure to SEBI, then under income tax. So both these will have to be correlated along with the financial statements where they will accrue the income. So mostly in these cases it will be difficult to go without disclosing the accrual. Yeah, so
What is the rate of taxation for the business income of this AIF?
regular slab rates. If it is a, yes,
Not MMR.
and if it is a trust, it will be an MMR. If it is an LLP, it will be in the 30% rate. Then if it's a company, as per 25%. So I think I have not spoken about the MAT applicability. So although there is this is in the hands of the AIF, although there is a tax holiday, still MAT might be applicable in these cases. However, since mostly now they are opting for new regime, MAT will not be coming into picture. But if they are opting for the old regime of taxation, still MAT tax has to be paid at 9% or whatever the rate is. So that will still be applicable. MAT or AMT depending on the constitution of the fund. Yeah, so we'll move on to taxation of category 3 funds. Category 3 funds are taxed in the hands of the funds itself. It is regulated under the Income Tax Act, which mentions this is section 10(4)(d) and 10(23) FBC. Category, even if it is not a business income, it will be taxed in the hands of the fund alone. Is it visible now? Yeah. So there is a differentiation in the category 3 fund. It can be a determinate fund like any other fund, or a fund which has only non-resident investors. Why this differentiation is, in case of a fund having only non-resident investors, there is a specific exemption under 10(4)(d), which I will talk about. For regular funds, let's say a determinate trust, I think many of you will be knowing what a determinate trust is. It is where both the beneficiaries as well as the proportion of their entitlement of income is fixed at the time of the trust deed itself. In that case, the income will be taxed in the hands of the trustee of the fund. It will not be taxed in the hands of the fund, it will be taxed in the hands of the trustee of the fund. He acts as a representative assessee. And what are the streams of income that comes under that an AIF3 has is it can have dividend income, it can have interest on foreign currency or capital gains and so on. Dividend income is taxed in the hands of non-resident investors at 20%. And interest on foreign currency debt is 20% again. Capital gains at the rates ranging from 10 to 40%, subject to tax treaty benefits for a non-resident. There are income from offshore funds also for AIF3 category 3 funds, where in case an Indian resident investor has invested in a category 3 AIF, his income from such investment, for example dividend income, will be taxed at applicable rates for him in India. And capital gains is taxed as per section 112, which is 12.5% generally, and if it's a long-term capital gain. And for a non-resident, they have given an exemption where this investment itself is not taxed. The income from such investment is not taxed. The gains arising from such investment is not taxed. If a non-resident has invested in a Cat 3 fund and he is earning capital gains out of that, supposing he has sold the fund, he has sold the units of the fund, then it is not taxable in the hands of the non-resident. Yeah. So 1023 FBC is this is not 1023 FBC, it's 10(4)(d).
So
This one, for the non-resident, right?
yeah.
Yeah, that's 10(4)(d).
10(4)(d), I just wanted to understand whether is it applicable only for funds set up in IFSC?
It is applicable only for funds set up in IFSC, and yes, and also for Cat 3 funds under SEBI. So it is applicable for Cat 3 funds under SEBI regulation, and also those funds set up under IFSC. Both these exemptions are given.
Because if you look at the way the definition of specified fund is worded,
Yes.
3 conditions have to be fulfilled.
Correct.
It's a Cat 3 fund or a non-retail scheme, and it should be located
Setting,
in
set up in an IFSC, but also Cat 3 fund under SEBI regulations. Let's go through that for a clarity's sake. Okay, I don't have the act here, but section 10(4)(d) also talks about category 3 fund under SEBI also.
I understand. One second. 10.4D says a specified fund means a fund which is established or incorporated in India in the form of trust or company or LLP or body corporate, which has been granted a certificate of registration at Cat 3 fund under the SEBI,
Yes.
under the SEBI's Act or IFSC Act, or which has been granted a certificate under retail scheme or an exchange traded fund. That is the first
Yes.
clause. Second limb says which is located in any international financial services center, and the third condition is all of its units are held by the sponsors or other than the sponsor are non-resident. So it's a cumulative condition, right?
Is it okay? Let me just check once. 1 second.
You have Roman 1.
So it is mentioned as and, is it?
No, it doesn't mean, okay. And is coming after located in IFSC.
So it is cumulative means it has to be only for applicable for IFSC funds.
IFSC funds.
Correct. I stand corrected. It is applicable only for funds situated in IFSC. Yes. Correct. It is not for category 3 funds which are not there in IFSC. It is only for category 3 funds in IFSC. This 10.4D exemption. And the thing is, it has to be only non-resident investors. They should not have investors outside India, in India, sorry. So it is a cumulative condition as you pointed out correctly. Yeah. They also define what specified securities are in section 10.4D. They are non-resident investors investing in specified securities in IFSC includes bonds, global depository receipts, rupee denominated bonds and derivatives on a recognized stock exchange, and where the consideration for such transactions paid in foreign currency. The objective is to encourage offshore investments in this case, and it has to be carried out from IFSCs like Gift City. It also provides tax certainty and relief to global investors using India as a financial service base. So there is one more important concept here. For a non-resident investor, the withholding tax happens at the gross income level. It is not after deduction. So an investor typically has an investment management fees which he has to pay for, which will be borne by the fund, which will be transferred to the investor also at the investor level. But this investment fee will not be considered as an income tax expense for the withholding tax purpose. He will not be, the fund has to deduct tax on the gross income basis. They will not be deducting tax after the expenses. This is in the case of non-resident investors. So for example, there is an interest income for the investor, non-resident of let's say 1 lakh, and there is an investment fee of 5,000. So the net income is 95,000, but the tax will be deducted at 1 lakh level, not after the deduction of expenses.
You are talking about Cat 3 AF.
Correct.
No, Cat 3 AF, assuming 10.4D is not applicable.
No, I am talking about category 1 and 2 also.
Oh, no, okay.
Category 1 and 2 also.
But in Cat 3 AF,
Cat 3 AF, it is taxed at the fund level only. So it is not applicable for Cat 3 AF, correct. It is only for Cat 1 and 2 funds. Any other question?
Just have one doubt in 10.4D. So there are this enlisted incomes which are granted
Correct.
exemption, right?
Yes.
So that transfer of securities other than shares of an Indian company.
Correct.
So I just wanted to understand because there are some talks when it comes to IFSC that the main purpose of granting this 10.4D exemption is had the non-resident made these investments directly, he would not have suffered any taxes. But just because these are routed through IFSC, he should not be suffering taxes because the
Correct.
fund is set up in IFSC. So
Correct.
I am granting you exemptions here. If you look at 10.4D, it will say transfer of specified securities listed in IFSC, business income from securitization trust, transfer of securities, and there is one more limb saying income from securities issued by non-residents, and there is one word which says to the extent such income does not accrue or arise in India. So just cumulatively reading, now the transfer of securities limb, does suppose for example an specified fund in IFSC invest in a bonds issued by an Indian company. So now will that exemption be available for that local investment, or and they are when you are offloading that bonds? That's
correct.
See,
they talks about transfer of securities and shares other than Indian companies, right? So you're asking if the non-resident investor, if he invests in an IFSC, and which in turn invests in Indian securities.
Indian securities.
Correct.
So now
In that case,
ah,
only it will not be see, in that case, what happens is, does it fall under foreign exchange? Is it a foreign exchange asset for the AIF? For the IFSC, yes, it will be. So other than shares of Indian company means he will have that exemption as well for that.
okay, because the only thing which I kind of hear from the people who are dealing in
Okay.
IFSC is had the non-resident done this investment directly,
Directly.
say in a bond of an Indian
Directly
company,
in the
bond of
bonds,
an Indian
okay.
company, and when that he is selling that bond, he would have suffered some tax.
Correct.
So by routing it through IFSC, he is getting
He is
this exemption.
getting that exemption.
Is that what is the intent of IFSC, or is the intent of IFSC such, if he had done a direct investment, he would not have suffered taxes, but now, say for example, if he has invested in a bond of, say, Apple, directly if he had done, the transaction is happening outside India, no
Correct.
tax. Now if it is done through a fund in IFSC, because the fund would be in India,
Indian.
possibility of it being taxed in India is there.
Correct.
So merely because it is routed through the fund, he should not suffer taxation, so I'm giving you the exemption.
Correct. See, the intention is to give them that benefit.
But even in cases where if they are done directly, they would have otherwise suffered taxation. But
Correct.
encouraging through fund investment, will they be eligible for exemption? Just wanted to hear
See,
from you.
that is the intention of the exemption itself is to give the overseas investors a tax exemption, not get them taxed for all the transfers that happens in the IFSC units.
Okay.
So he is investing in an IFSC unit. Only to that extent we can see.
Okay.
We can't be seeing in turn what happens after that. So if he has invested in an IFSC unit and he is transferring the units, that means there will be no tax on that.
Okay.
So there might be cases like you say where instead of directly routing it, directly investing in a company, he is routing it through the IFSC. But it is the exemption that is given to them.
Okay, because the thing is, what happens is some people set up feeder funds in IFSC, in the
Correct.
fund of funds, and they further invest in AIFs outside of IFSC.
Correct.
So naturally, what happens is if the non-resident has to directly invest in AIF, he would have suffered taxation when he's selling that.
Correct.
But just because it is routed through some fund in IFSC,
Correct.
he gets the exemption there. So
Correct.
kind of a lot of tax arbitrage. Is that what is the intent of
The intent is to give them that exemption.
Just wanted
To
hear,
bring in more offshore investments, they are giving tax exemptions to the non-residents.
because in some circles the thought process is this is not what is captured.
What
in
is the
10
intention?
Because that there is one line in 1040 which says that except where the income otherwise accrues or
arises
So
from India.
From India. So that line you will have to read it with every item
With the
of
total
limb. So
limb.
if these incomes are otherwise accruing or arising in India, then none of these exemptions will apply. Is what they are reading this entirety
Okay.
of the provision.
Okay.
Doesn't seem so, but just
Yes.
wanted to hear.
It doesn't look like that from the angle of the non-resident investor, because for him, although they might mention income accruing in India, his income stops at the fund level in IFSC,
Correct.
which is outside of Indian territory.
Okay.
Yeah.
Thing maybe like what was saying, that if he's going to invest in this fund and that fund is going to be in AIF is only when the regulation and everything kicks in, right? So if it's going to be in a company or something which is outside the scope of
Okay.
AIF, so it's not going to be regulated as what it is.
Correct.
So that's so only when you bring it under a regulation, that is when you will be eligible for getting an exemption under 1040. Is
Correct.
my
Correct. It has to be under the IFSCA regulation.
So otherwise, irrespective of that, for a category 3 fund,
In an IFSC.
no, the investor does not have any tax impact on that.
Correct. Correct. An investor does not have tax impact on that, on a category 3 fund investment. It is at the fund level. So that I think sums up what the benefit is given, because the taxation is at fund level.
Correct.
Yeah.
Thanks.
Then there might be some cases where there are offshore funds which are looking at relocating to India, to GIFT City, which are looking to relocate to IFSC funds. So there is a tax neutral relocation that's applicable for them. It applies to offshore funds located in countries with a tax treaty in India. This benefit is generally available to offshore funds which are established in jurisdictions that have a tax treaty with India. This ensures that the funds come from regulated sources from countries that already have a working tax framework with India, and the intention is to encourage genuine and compliant fund strategies and migrations. The migration window earlier was only up to 2025. Now they have extended to 2030 as well in the recent Finance Act budget. The transition must be completed by 2030, that is. That's a considerable window giving time to the fund managers to identify legal issues, identify how to set up their transfers to the Indian territory and so on. However, it is advisable to start early to deal with regulatory and operational formalities in the case of a transition to India, to GIFT City. And one of the key advantages is there is complete tax neutrality in this transfer from a foreign offshore fund to a fund in IFSC. It does not suffer capital gains at all. There is no capital gains on this transfer. No tax on the IFSC based fund receiving the assets also. For the IFSC fund which is receiving the assets, there is also no tax, because otherwise if it is receiving funds at no consideration, there is some 56 to 10, all that will be applicable. In this case, there is nothing like that. And there is no capital gains for the investors who are already invested in the offshore funds. They are now migrated to IFSC units. That's all. So they provided there are certain conditions they have to meet, like giving declarations to the authorities and so on. Otherwise, it is a pretty straightforward scheme that has been introduced for migration of funds.
The investments also will be taken over by the IFSC.
Correct. So the fund which is located in the IFSC is the one which is receiving, which is the fund which is receiving the offshore units. So this transfer, generally if it's a transfer of units or if it transfer of some securities, there is capital gains. This is specifically mentioned in section 47 as not a transfer.
So valuation and all has to be done, or without
That's what certain things like valuation will be done. Valuation has to be done from a IFSC point of view. Sorry? It is without consideration. But still valuation has to be done, because at the time of migration, at the time of at the time of moving to India IFSC, the net assets have to be valued. That is as per IFSC regulations.
net assets that you are
Transferring,
from the offshore.
correct, or acquiring from the offshore unit.
Even though if it is part of a larger investment, then
Correct.
the 6 months timeline is still there.
The timeline is still there. 6 months is there.
Are there any other additional regulations such as like such relocation? Do we have to comply with any other additional requirements of FEMA or?
There are not FEMA, there are certain IFSC regulations, like for example, certain disclosures, what is the amount of investment made, valuation of investment, who is going to be the sponsor, who is going to be the fund manager at IFSC level. And
presumably these transactions are to be done only at book value, I presume. So,
no, the transactions are to be done at book value, but the valuation has to be made for a disclosure purpose. The transactions will be done at book value.
yeah, so when if it's done at book value, then would there be any
There
requirement
are
additional
certain
valuation?
disclosures which the offshore fund has to do while migrating to IFSC. For a disclosure purpose, the valuation has to be done.
So basically, then we may, as chartered accountants, we might have opportunities.
We will
where
have
are going
opportunities.
to-
Yes, certainly,
Right, right.
certainly. Till now, there are about 12 funds which have relocated to India from outside, mostly from Singapore and Mauritius. They form the majority of the relocations. And for them also, all this tax benefits like 80 LA will apply. So not 80 LA, nil capital gains and all that will apply.
When you say relocation, the units were transferred or actual relocation?
So there is, let's say, a fund in Singapore. They are looking at investing in India, in IFSC India. They will move the whole of the investments in the fund. So the fund has investments as well, right? So that will also be relocated to a let's say an entity in IFSC. So the entity in IFSC will now be holding all those assets. It will still be in foreign exchange only. So since IFSC itself is like an offshore unit, so the transfer is easy. It will still be in foreign exchange. It will be like a transfer of all the investments from one fund to another.
For example, you say the Singapore fund
Hmm.
is a trust.
Okay.
Now they have investments across Asia and they want to move the investments in India to the IFSC.
Move investments in India.
Yeah, the Indian investments alone.
Okay, okay.
And then that some demerger or something has to be done.
So they want to move the Indian investments alone to IFSC.
IFSC and then allocate to swap those units.
No, for that they will not be able to do that only. In that case, they'll have to move the funds as such entirely. They will not be able to relocate one particular investment in India to a fund in IFSC. They'll have to relocate to IFSC and then do that. Otherwise, what they can do is they can transfer those funds, the investments in India. They can set up a specific fund in IFSC, transfer those investments in IFSC without transferring the offshore unit assets in Singapore. So they'll be operating in IFSC, they'll be operating in Singapore in both centers.
So the reason I asked is even the exemption of transfer is also applicable when a old or new fund takes over the units of the earlier.
Correct, correct.
So
In that scenario, yes, they have to set up a fund in IFSC, transfer those Indian investments to that. In that case, it will be like a demerger. Correct. Demerger typically typically does not happen like that for trusts. They'll have to shift their investments. They'll have to create a fund in IFSC and then shift. They'll have to start a new fund in IFSC and then they'll have to give some. In this case, mostly there will be a consideration which has to be given because it's only a particular investment list of investments that you're transferring. That does not happen very straightforward in this case. Because generally offshore funds have a typical scheme under which they have hold the investments. So you'll have to transfer the scheme also. So there are some gray areas in that where if you are going to transfer only portion of that, then whether you'll have to start a new trust. Ideally it has to happen that way. But whether tax exemption will be there, I don't think it will be there, where you have to create a new trust, give consideration to the trust and then transfer the investments.
typically loss making assets will be transferred like that. So that
Correct. Correct.
the question of paying money also.
Money will not arise in those cases. Yeah. So I think I have spoken about certain specific income tax filings that has to be done for the AIFs. The first one is 49BA. That is the PAN exemption declaration which has to be given by the investors to the fund. The funds will in turn file it with the income tax return. That can be done for new investors every quarter. The name of the investor, contact, tax identification number abroad, investment details, declaration, all that has to be submitted.
Basically, TRC is a must.
TRC is a must. Definitely they will have to get the TRCs. Along with all these requirements like name and all that, they will have to get the TRC from the investors, because only based on that all the withholding taxes apply. And this also these conditions are to be submitted to the income tax as well as declarations in this. But this is only for PAN exemption 49BA. 64D and 64C I have already explained. So there is again a form 61B which is to be filed in the reporting portal, in the Insight portal. This is a declaration for certain specific category of investors, not for all investors in IFSC. In case they have investors falling under a particular category of, let's say a US investor is there, he meets certain criterias. The fund has to do due diligence whether he meets those criterias. There is a level like, let's say $50,000 for example, minimum $50,000 investments has to be made by the investor. Only then he will fall under that category for reporting. So basically this form 61B, the fund is reporting to the income tax portal that these are the investors who satisfy these categories for whom I am reporting income. This is the income that is given to him, and this is to be reported by the income tax authorities to let's say a country like US, where FATCA compliance comes into place. So the rule 114H talks about the due diligence that a fund has to make to identify those investors who fall under this category of reporting. For pre-existing accounts as on 30th June 2014, there are certain exemptions, but for new accounts, all the reporting has to be done for all the investors who meet certain criteria. The next one is Rule 114F covers AIFs conducting fund management or portfolio investment. So the 61B reporting broadly falls under 114F, G and H. 114F talks about AIFs conducting fund management or portfolio investment schemes, which have to report as a financial institution. So the AIF falls under the category of a financial institution. Only because of that they have to make the reporting. Yeah. So we'll talk about the accounting angles for an AIF and in IFSC. So as you know, the transactions happen in foreign currency only. See, they have to maintain accounts in foreign currency. Because this is permitted by the IFSC AIF, they can't maintain in Indian rupees at all. The audit reports are to be given for the AIFs. A chartered accountant in India can typically give an audit report for a fund in IFSC. That is allowed. And so since it is in foreign currency, for income tax purpose, let's say the IFSC is filing an income tax return, that has to be converted to Indian rupees. So a chartered accountant can give a special purpose financial statement in this case, converting those foreign currencies to INR for the purpose of filing income tax returns. Generally, that is the practice that happens in IFSC AIFs. Apart from that, the accounting standards are also applicable based on the level of non-corporate. These are all non-corporate entities we are talking about. Based on the level of non-corporate entity prescribed by the ICAI, there are certain categories like net worth, there are certain categories like turnover and all that. Based on that, accounting standards will apply. For a category level 1 entity, all the accounting standards will apply. For a level 3 entity, only 10 accounting standards will apply. So whatever accounting standards apply, the financial statements will be as per those accounting standards. So this is another area of opportunity for chartered accountants. And income tax return has to be filed in INR. They cannot be denominated in foreign currency. There are certain other taxation aspects. Section 47 AB. This is for non-residents where they have invested in a recognized stock exchange in IFSC. I have earlier mentioned about 2 stock exchanges in IFSC. In case a non-resident invests in a stock exchange in IFSC and he has sold those units, these are exempt under section 47 as transfers, which I explained a little while back. If they are bonds under section 115 AC or a rupee denominated bond or derivatives or other notified securities, such transfers are not, if the transfer happens, these transfers are not regarded as such, hence capital gains does not arise. Apart from that, there are certain notified assets for which there is no taxation, such as foreign currency bonds, mutual funds and all that, which is listed in an IFSC. And goods and service tax, in this case, IFSC is treated to be under an SEZ category because GIFT City falls under SEZ. So all the SEZ rules for in the case of a GST will apply. If the units within the IFSC are transacting with each other, there will be no GST on that. However, if let's say we are transacting with a unit in IFSC, we are raising a bill to an entity in IFSC, that will be a zero rated supply under GST. And if we have incurred any expenses on that, and if there are GST inputs, we can claim this as refund. IFSC units are typically not taxable under GST. So FEMA regulations, which we have discussed earlier, FEMA regulations we have discussed a little while back. For a resident individual, direct investment in IFSC AIFs are allowed. and it will be under the LRS scheme where a $250 limit is prescribed for a resident individual. For a corporate entity, it will be like an ODI, overseas direct investments. So an Indian entity or an Indian individual can also invest in IFSC. Again, so there are plenty of opportunities that have opened up for chartered accountants in GIFT City as well as AIF. Let's first talk about what are the opportunities in AIF. Chartered accountant can typically do advisory services, structuring, setting up of AIFs and so on. Fund setup that happens generally. Probably we can advise them what are the documents that are required, regulatory aspects, if they want to have what are the type of categories of funds that they need and all that, we can advise them. And we also can do regular audits for the AIF. And taxation and transfer pricing can be done. Advisory on IFSC tax regime can be done. Transfer pricing of cross-border entries can also be done. And NAV calculation, which is to be done on a quarterly basis, can also be done by chartered accountants, and fund accounting, investor reporting and so on. In the case of a GIFT City, there are specific regulation. There is a specific regulation for bookkeeping, accounting, taxation, and compliance services called BATF. So this itself is a separate regulation on its own. This opens up opportunities for chartered accountants where they can set up their offices there in IFSC. They have to have a physical office there, and they can do accounting services like reviewing, preparing, compiling, analyzing, or supporting financial statements, supporting financial statements based on client data and so on. Taxation angles such as consultation, tax return preparation, tax planning, and such other advisory services like transfer pricing. Bookkeeping can be done. They can help in classifying and recording transactions. So for setting up a unit in IFSC for a chartered accountant, we'll have to get a license from them. We'll have to set up a entity there physically and get a license from them. Based on the license, we can do all this work. Without a license, we will not be able to do these services. From IFSC. The license will be taken from the IFSC. So generally, no, it is a BATF regulation. It is a bookkeeping, accounting, taxation license from IFSC, which is issued by the IFSC. So you'll need to have a principal officer designated there, who is situated there. He is generally a chartered accountant or a cost accountant or a certain other professions like CS or a lawyer. He can set up an office there. He can get himself licensed under IFSC as an entity under BATF regulations, and then do the accounting services for the funds situated there. For example, there are banks situated there. A chartered accountant having office there can advise the banks on fraud management, on PMLA regulations. All those are also possible. Transaction monitoring, all those are also possible. He can also advise them on he can advise certain entities on bookkeeping. He can maintain the books for them. All that can be done. NAV calculations also can be done by a chartered accountant there. And also there are opportunities in IFSCA for sandbox. Sandbox it is like, let's say in Chennai we have this IIT research park for startups. It is like a startup research center for a fintech company in IFSC. Incubation centers. But purely for fintech companies, where you get real-time investors who are looking out for such companies. They will test your products, and you will be able to have let's say a workshop for them. And you will also be given amenities, technology and so on to build your product. That is what a sandbox is. So that also is possible. So we can help those fintechs with accounting compliance and analytical ESG reporting and so on. So these are the broad opportunities for a chartered accountant. We also can help in return filing, as I mentioned earlier, income tax return filing. All that is applicable for them. So till now, any questions? There are certain other important aspects which I would like to discuss, like income tax return filing, for example. In the case of a category 1 and 2 fund, we'll have to disclose, because it is a pass-through fund, it has to be disclosed under income from other sources for an investor. We are talking from an investor point of view. He will have to disclose it under other sources, while a fund has to report it under exempt income, because it is not exempted in the hands of a fund. We have faced certain assessments for this, where we had to tell the assessing officer why it is passed through and so on, because they are not able to directly link this to an investor's point of view. They are only looking at the AIF point of view. They are asking why AIF should not be taxed, why should they not be registered under GST, and so on. And we faced difficulties in explaining those concepts generally. And exempt income has to be shown under the Cat 2 funds or Cat 1 funds and so on. For a category 3 fund, it is taxed in the hands of the fund, right? So this has to be disclosed as special income funds, special income which are taxable at special rates under the income tax return. And all the investments that the AIF earns, all the income that it earns has to be is taxed at special rates. So it has to come under special taxation regime in the income tax return. Yes. Apart from that, in the case of a gift city, the Gujarat government also has given certain exemptions, such as stamp duty exemptions for those who are registering in gift city, STT exemptions are there, and so on. Yeah.
Recently, these issues on the management fee paid to the investment manager. That was the GST.
Correct.
How is it handled?
So for the investment management and for the investment manager, it is applicable.
So is there any other way to
GST is applicable for an investment manager, because the charges that he does, it is for the investment management, right?
fixed fee, right? It is on the success based.
Correct.
So success based on a carry.
See, you can't link that directly to the securities or success base, but whatever income, he has to tax that on an accrual basis, right? He has to accrue that income. Sorry?
It is not like a recurring service provider. Because end of the
Correct.
day, that investment manager would have also invested in the.
Correct.
So he also becomes an investor in it. So,
Correct.
So what it become?
No, he does. So the thing is, the income that he derives from the AIF or from the IFSC, it can be in two ways. One is through his regular some investment that he has to maintain. Through that will not be falling under GST category. But he also charges the management fee to the fund. That will fall under GST angle, because we also faced an issue with the GST officer where we had to tell them that these investment management entities are all taxed only under GST. So there is no specific exemption for them, even though it might not be on a recurring basis. It might be based on the ticket size, it might be based on the investment income. Still, whenever they raise an invoice, they'll have to tax on that. Or if they have a system of continuously raising invoices, they'll have to tax like that. So GST is applicable for them. I think you're trying to say that there are no specific exemptions given under GST for this. For example, a school or an education institution has exemption in GST on their school fees and all that. In the case of an investment management, there is no such exemption. But the fund itself is exempted because it deals in securities and so on. And the securities are typically not falling under GST purview. So there are like few more examples that we can talk about. How does a non-resident Indian invest in a AIF or an IFSC? For him, it is again a foreign transaction only. So he can do his regular FDI route of investment and so on. For a non-resident NRI investor, they can invest in the gift city as well. That is also possible. And for an Indian investor, they can again raise funds from the units in IFSC. So that is that. Yep. So we have come to the end of the discussion as such. So if you feel like we can discuss anything else, we can. Any other questions? Not required. So AIF can be registered under IFSC only. So the thing is, under IFSC, you are not directly falling under an AIF category. You are falling under a FME, fund management entity. So you will be registered as a fund management entity, which will be doing activities of managing funds of an AIF in Gift City. So you don't have to separately register. So any other questions? Okay. So it is great having you all here. Thank you for your patience. Yeah. Thank you so much. If you have any queries, you can also write to me. This is my mobile number. Okay. Thank you.